Welcome to St Andrews on the Terrace for the third in the series of lectures under the banner of Shaking the Foundations. Please welcome Professor Lloyd Gearing, who will introduce today's lecturer, Brian Easton. Thank you.
Good afternoon, everyone. As most of you know, this series on uncertainty was sparked off by the series of earthquakes in Christchurch, and that is why we started off with one on geological uncertainty, moving then to spiritual uncertainty, and today, economic uncertainty. Most of us who don't know much about money affairs, nevertheless, cannot help being aware of in macroeconomics, of the various depressions that take place from time to time and which affect us all in all sorts of ways. And more recently, because of certain factors overseas, I understand, we have been suffering certain uncertainties in the money field, and some people who were investing in finance companies, to their sorrow, lost quite a bit of what they had. So we thought we should have something on economic uncertainty, and turned to a good friend of the Study Trust, Dr. Brian Easton. He's no newcomer to the Study Trust. He's given lectures here before. And what is more important, he was a member of the board of the Study Trust for quite a few years and made a very significant contribution to that. In fact, I think the trouble was that we didn't realise at the time what a specialist we had in our midst. We just took him as Brian Easton, a citizen of Wellington. And it's only later that we came to realise what a distinguished career he has had as an economist. He started off with an honours degree in mathematics at Canterbury. I must congratulate him on choosing mathematics. And then he moved to Victoria, where he did an honours degree in economics. Then he got caught up in research in economics, did some lecturing in economics, both in Canterbury and in UK. And then for some 5 years, he was the head of the New Zealand Institute of Economic Research. Indeed, his successor is the person who now holds the position of Governor of the Reserve Bank. So you can see he went through quite a few stages, and that is why the University of Canterbury awarded him with a Doctor of Science in 2003. He has written many books, many publications. The last 25 years he has described himself as a private scholar and works, as it were, from that background. So we're very fortunate today to have him open up what is for some of us the mysteries of economics today in economic uncertainty. Please welcome Dr. Brian Easton.
Tēnā koutou katoa. Thank you for that introduction. Thank you for coming. The notion of uncertainty and risk, which we will see as something quite different, is central to economics and the economies. Of course, there are external events which generate shocks, like the Lisbon or Canterbury earthquakes. But today I'm going to talk about the financial shocks which the economic system generates. It's a complex story, so I'm going to have to leave some of the important bits out to keep within the time. Financial shocks occur almost exclusively in modern market economies. Bubbles, panics, depressions and recessions and the global financial crises are very rare in traditional societies. One of the central characteristics of a modern market economy is that money is pervasive. Economists have been long aware that money, and some different but related phenomena I'll talk about today, are central to these shocks. Today's presentation is about how they are. While some talk of the mystery of money, the only mystery to an economist is why people get confused about it. Perhaps they don't think rigorously, perhaps they muddle concepts. For an economist, money is the medium of exchange, what people are willing to accept in exchange when they're selling something or settling a debt. There are other functions of money, a standard of value and a means of deferred payment. But these are convenient consequences of money being a medium of exchange. Now, I've not got time to go into why some things are money and others are not. Perhaps in a modern economy, the test is that if you can pay your taxes with something, it's money. That includes coins, notes, and cheques. There are also things called near money, things that can be easily converted into money. For instance, if you have a bill or taxes to pay, you can usually go to the bank and transfer from your savings account to your current account and write the cheque on that. A savings account is near money. A cheque account is money. You can pay your bills directly from it. That something has a dollar value on it does not mean it's money or near money. You can also sell your house to obtain money, and you need to pay a bill. That is far more complicated, selling a house, so it's hardly sensible to call your house near money. It's an asset. It's important for the story I'm about to tell that you are uncertain about how much cash you'll get when you sell your house. That's different from your bank deposit. You know exactly how much it's worth. A particular class of assets is financial paper. These are contracts to pay a certain amount of money at some time in the future. They are neither money nor near money. Perhaps the simplest example is an IOU, which is a contract, a promise to pay a certain amount in the future. If the IOU is from your much trusted brother-in-law, who is a billionaire, you're pretty certain it'll be paid. If it's in your balance sheet as an asset, but it's in your balance sheet as an asset, but it's in his, the promises, as a liability. There's always two sides. You may even sell the IOU to someone, although its value might be discounted a little because the purchaser is not as trusting of your brother-in-law as you are. Much financial paper is not nearly so secure. For instance, some New Zealanders have deposits in finance companies which have gone bankrupt. Whatever the face value of the deposit, the actual return will be zilch if the finance company is unable to pay it back. Sure, there is a contract which says the company will pay, that is, give you the money, in exchange for the deposit with them. But if they can't, the contract is worthless. The value of a IOU is the money you can convert it into. That is different from an asset like a house. A house is a house is a house. Something tangible with an intrinsic value. Certainly houses have monetary value, but an IOU, like all financial paper, has only monetary value. IOU and deposits in finance companies are simple forms of financial paper. There are many more complicated ones. In a modern financial system, some of the most important financial paper are contracts where the payouts are dependent upon contingent events. An early form of such a contingent contract was life insurance, which involved one party, say a person, paying another, a life insurance company, a certain amount, with the second party agreeing to pay a somewhat larger amount if a particular person died before a particular date. The reason they could offer such a deal is that while we cannot be sure when a particular person will die, based on past experience, the life companies have a good idea about how many in a pool of people will. So the risk of an individual dying can be calculated and the event insured against. Is there a fundamental difference between investing in the contingent contract and gambling? Between a contractor insuring a life and a contract that if a thrown dice comes up, say even, you get paid, and if it comes up odd, you pay. Is there a difference? There is not a lot. The mathematics are much the same. The distinction is often made according to the usefulness of insuring the transaction. It would seem prudent for a firm to insure the life of its chief executive, since there would be great difficulties if he dies suddenly. But what about somebody else betting on the chief executive dying? Maybe they're a shareholder in the firm, or maybe they just want to gamble. This becomes very pertinent when you insure against a firm or a country, as they have been with Greek, a firm or a country going bankrupt. There have been recent examples where the amounts insured far exceed that which might be lost if the event occurs. Some of that money must be, or some of those contracts must be gambling. Insurance may be the simplest form of financial paper. That is a contract whose payment depends on a contingent event. But a whole raft of increasingly complex ones have developed. Among them are shares, futures, options, swaps, hedges, and derivatives. In each case, some parties make a contract whose payout depends on whether a particular event occurs. We get mesmerised by the mind-boggling sums attached to the value of a particular piece of financial paper. However, behind the row of zeros is the simple idea that there is a contract in which one party has agreed to pay the other an amount if certain circumstances occur, and that one party thinks that the value of that contract is a large number. It may not be, of course, since the contingent outcome may be different from the valuing party assumes. But if enough of this financial paper is held in the investor's portfolio, the wins and losses average to the average value of the portfolio. Clearly, it's critical how the financial paper, the contingent contracts, are valued. If this can be done in an objective way, so we can all agree on its value, then the financial paper can be bought and sold. This liquidity makes the financial paper more attractive to investors who may need the cash before the events and the contractors have played out. Over the years, many economists and others have developed very sophisticated techniques for valuing the contingent contracts, the financial paper, and developed an analysis called portfolio theory. The valuation requires some assessment of the probability distribution which underpins the contingent events. Now, I might lose the audience if I went through the mathematics, so let me just say it depends on a couple of parameters. And if I could just sneak in here, the parameters are the mean and the variance or the standard deviation of the distribution. Now, suppose we don't know the parameters. Here we've got a theory that uses parameters. Suppose we don't know them. John Maynard Keynes pointed out you suffered uninsurable uncertainty rather than insurable risk. The distinction is that risk is about known unknowns. Uncertainty is about unknown unknowns. If there is uncertainty, you cannot know the key parameters. Portfolio theory does not work. However, some Bayesian statisticians said you could use your best guesses. The dispute is a bit complicated. You can read about it in Skidolski's Return of the Master. But there are two key points. First, suppose everyone is wrong about the parameters of the distribution. There may be major distress when the contingent event becomes a reality. Second, and more subtly, the relevant parameters may be literally unknowable. I won't go through the details, but mathematician Benoit Mandelbrot, yeah, that's the Mandelbrot set, that's him, this is the same man, observed what he called 10 sigma storms in financial markets, pointing out that according to big portfolio theory, the probability of these large fluctuations would be a few millionths of a millionth of a millionth of a millionth. But in fact, one observes spikes on a regular basis, as often as one every month, and their probability amounts to a few hundredths. He warned of 10 sigma storms a decade before the perfect storm of the global financial crisis. But no one listened. Why? One kind of answer is that portfolio theory may be imperfect, but neither Keynes nor Mandelbrot offered an alternative to portfolio theory. So the theory continued to be used. This is a nice illustration of the scientific truth that theories get replaced not because they're known to be wrong, but because someone finds a better theory. And nobody found a better theory of investment. Additionally, some people became very rich from portfolio theory. They have a vested interest in defending the theory, and since we give great weight to the judgment of the rich on a whole range of issues outside any competence they have, everyone assumed that portfolio theory that made them rich must be right. Another kind of answer as to why we ignored the warnings was that portfolio theory seemed to work reasonably well up till then. Of course, there were the odd crisis, the dot-com bust, the Enron debacle, the failure of long-term capital markets, a firm whose board of directors included a couple of economists who were Nobel laureates for their contributions to portfolio theory. Most of the time, the financial system managed to get through these crises. Firms are always falling over. Contracts are always going wrong. Most businesses have a list of bad debts. But the system has muddled through, and it was assumed it would continue to do so. Yet, as Mandelbrot predicted, there would be occasions when there was a perfect storm in which the financial system breaks down into a systemic crisis. The 2008 global financial crisis was one. It's not the first systemic financial crisis. You can go back to the 17th century with the Dutch tulip bubble, and there have been many more since. I doubt that the GFC will be the last. It is only unusual because of its size, reflecting the increasing global interdependence of the financial system. When the tulip market crashed in Amsterdam, there was barely any impact on London, just over the way. There's perhaps an even more fundamental reason why financial paper has become so important. Karl Marx shrewdly summarised the changes in the evolving capitalist economy in the mid-19th century by the changing role of money. Once he said the economy could be represented, and I have the little diagram up there, by C to M to C. That is, you started with a commodity, perhaps you made it yourself, which you converted it into money, M, and then you converted it into another commodity, C dash, which you would rather have than what you made yourself. Money in this circuit was a means to an end, not an end in itself. However, Marx observed that the economy evolved, as the economy evolved, a new circuit developed, M to C to M plus. Here one starts with money, converts it into a commodity, which in turn is used to convert into more money. That reverses the roles. Money becomes the end and the commodities are a means to the end. More recently, the commodity in the circuit has been replaced by financial paper. You no longer have to produce commodities to make money. You can do it by producing financial paper, contracts about contingent events. Money values begin to supplant intrinsic values in the way we think about the economy. How could this have happened? Why does the M to FP to M plus seem to generate profits in good times? The conventional wisdom said it arose because the financial system was organised around allocating risk between investors. There's no Keynes or Mandelbrot critique of the existence of uncertainty in the conventional wisdom. I don't think there's any uncertainty in the conventional wisdom. It is said that some low-risk investors were willing to pay others, high-risk investors, to take over their more risky contracts, just as you will pay a life insurance office to reduce the risk of your widow living in penury if you die early. Now, I haven't heard this particular explanation since the 2008 global financial crisis, for it seemed a bit naive when a lot of low-risk investors were hammered while some high-risk investors were barely touched. But even before then, high-risk investors and those transacting on their behalf seemed to be making a lot more money than could be justified by the marginal difference in risk that they were trading. So let me offer an alternative explanation is why does the financial paper and the money-to-money circuit seem to generate profits in good times? Financial paper are contracts about events in the future. We may attach probabilities to the outcomes of those events, but until they actually happen, we don't know the true value of the financial paper. In principle, the combined positive and negative values of the financial paper ought to be zero in the world's balance sheet. When someone has an investment portfolio with billions of dollars of financial paper as assets, someone else has in their balance sheet the same financial paper as a liability. They've made a promise to pay a contract. You can see this in your household balance sheet. There may be a deposit in the bank of $10,000, and in the bank's balance sheet, that's your asset. In the bank's balance sheet, there's an offsetting liability of $10,000. The two together exactly cancel each other out. But because financial paper involves guesses about the future, They may be valued in different ways, so that the net position of the world's balance sheet may be increased by financial paper. We have to guess at the underlying probabilities. Different people make different guesses, and the combinations of their guesses may not obey the laws of probability. The mismatch can add to the world's wealth in the short run. Now, this is such a startling phenomenon that I need to explain it step by step. I'm going to use an example of a housing bubble. Suppose one day someone authoritative announced that the value of all houses in New Zealand had doubled. All house owners would dutifully enter the new value in their balance sheet, if they were meticulous enough to keep one, and feel they were much richer. But are they? This is only a change in the monetary value of your house, in which what it is worth if you sell it. The doubling of the market value of your house has little effect on its intrinsic value. You may say, I'm twice as rich, but you're unlikely to say, I'm enjoying living in the house twice as much. A complication is mortgage debt, which acts as a brake on rising home prices. If the brake is weak, as it was in the last decade when the banks were flush with overseas funds, house prices rise as homeowners try to show off their wealth with more grandiose homes. And they try to increase their wealth from the capital gains which come from leveraged purchases in a rising market. Now, one of the rules of economics, fundamental rules of economics, is Stein laws, which is, if it can't last, it won't. House prices cannot rise forever relative to ordinary prices, so at some time after a boom, they will stagnate or even crash. You would have thought that investors could have figured that out, but research increasingly shows that their behaviour is not entirely rational. Again, this is a huge topic in its own right, so I have to skip it, but if you're interested, you might read psychologist Daniel Kahneman's Thinking Fast, Thinking Slow, and economist Robert Shiller's Irrational Exuberance. It's extraordinary just how irrational investment decisions can be. It probably arises because if you make an unwise investment decision, you really get a immediate signal that it is stupid. Without early feedback, learning is dampened. In any case, just about everyone else is doing it too, so how can it be foolish? Or so it seems until the day the crash occurs. The same applies to financial paper generally. Now, you might think that while ordinary human beings are unsound investors, but surely those in the investment industry are not. It turns out they're actually just as unsound as us. The difference is that they're richer. Should their judgments be disciplined by the powerful mathematical models they use? You may remember most of them said they didn't understand them shortly after the GFC. That only applies if the models are correct. Recall that Keynes said they are fundamentally flawed because they pretend uncertainty can be converted into risk. And if the models have the right assumption, and the models have to have the right assumption, and Mandelbrot says they haven't. But surely financial paper can't add to net wealth since the contracts net out. Only in the long run, and in the interim, the two sides of the contract may value them differently. A simple example might be a ninja. No income, no job, no assets. You may remember they were borrowing like fury in America. A ninja who has borrowed to purchase a house may have no intention of paying the debt back. And he values his side of the mortgage in the balance sheet as zero. But the lender is likely to put the mortgage into her or his book at full or perhaps partial value. So you've got an inconsistency between the two valuations. They don't net out between the two balance sheets. Now, unlike a house, there is no intrinsic value in a financial paper. And I might quote Yoga Berra slightly differently. The intrinsic value of financial paper is not worth the paper that they're written on. Its value is the money you can turn it into by selling it to someone else. So nobody finds out the real value of the contract until it's settled. And the US housing market began to look soggy in 2006 when the ninjas began to stop paying. Because there's no way to resolve the actual value of the financial paper, the contingent contract, until the settlement happens in the future, it is possible for the net value of financial paper in the balance book of the world to be positive rather than zero. Investors act on the apparent but deceptive increase in wealth, which leads to that bullish market we call a bubble. At some point, reality undermines their speculation based on false assumptions, and the bubble pops, the financial system collapses, and the economy goes into downswing. During the reversal, the false profits have to unwind, and which is why we expect a long recession after a major crisis. And remember, we're already in the 5th year of the recession associated with the global financial crisis, some countries in the 6th and 7th. Much longer than you remember the shallow speculators in 2008 told you that it'll all be over soon. Buy my product. Some informed commentators think that the current recession may last 5 years. Others think that they are optimists. Now, I could extend the story through to the details of how the global financial crisis occurred. It's already much there in the story already, isn't it? I could detail it. But instead I want to make 4 analytic points. The first is that people become exposed to the financial paper without understanding how sound or unsound the underlying contract is. A simple example, you. It happens all the time. I don't know much about the bad debts of the bank that I have my deposits with. I believe they're under control and that the equity of the shareholders provides a cushion to protect me. And that's broadly true in the New Zealand's conservative banks, but that's not always true for overseas institutions. The second point is that dealers profit as the financial paper was bought and sold. In the main, their profits are offset by the losses of those on the wrong sides of the contract. However, the latter happened sometime later, so the dealers seem to be making a profit out of thin air. What they're really doing is they're taking over investors' savings. Third, the system would work a lot better during the downturn if people had not borrowed for their speculative investments. The problem in the housing boom is not the values of the houses, no matter how ludicrous they are, but that people have mortgages on them, which they used when they bought them for these fictitious values. And the final point is that some debt was taken on in actions that were more like gambling than investment. As I said, the distinction is not clear. Indeed, the vernacular describes betting on the TAB as an investment. Now, I have no problems with someone who punts on horses for recreational purposes, providing they do not bet more than they can afford. They may pretend they will win, but generally they don't. The punting is for the fun, gives you an incentive to follow the horses more closely. The problem arises when you bet your house on the horse, or take a mortgage out to bet on some dark horse of a financial paper. Now, I'm not the first person to draw attention to the gambling in the financial systems. When the financial system was a lot less complex than it was today, Keynes vociferously described the share market as a casino, remarking, when the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. However, the problem is not the gambling per se, but the gambling with other people's monies, because that's what his debt is, it's other people's money. Should the gambling occur? Let me give an answer with an analogy from the Canterbury earthquake. It was a consequence of the Indo-Australian and Pacific tectonic plates ramming into one another. Earthquakes occur largely near plate boundaries from releasing some of the titanic forces as they clash. If these two plates were not crashing into one another, the Zealandian continent would be almost entirely under the sea. It was heading that way 22 million years ago, until the Pacific plate began expanding. It smashed into the Indo-Australian plate, and that drove up a sunken part of the Zealandian continent into the landmass we call New Zealand. If that had not happened, we would not be here, or there would be sea, and there'd be no earthquakes. Earthquakes are the collateral damage of living in New Zealand. Better not to have them, but they're there because we're here. Financial crises are kinds of earthquakes. They too are consequences of an upheaval, the market, money economy. No markets, no money, no financial crises. But we would be much poorer for it. You may think Africans are poor, and of course they are, but even their material standard of living today is about 3 times higher than it was 200 years ago. Ours, by the way, is 20 times higher. But even they have benefited from the world economic development. That was the consequence of the market economy, which enabled specialisation and encouraged innovation. But its downside is the financial crisis. Such crises are an inherent feature of our economic system. Even if we restrict people from gambling with other people's monies, its failure may have been compounded by the stupidity of investors and by what economists tactfully describe as misalignment of incentives, which is sometimes amounts to fraud and corruption, and it may also have been made worse by poor economic management. But the crisis will happen even if these failures are addressed. Perhaps less often, perhaps less violently, but they'll occur. Certainly we should address those failures as far as we're able, with the humble recognition that human ingenuity tends to outwit the most careful institutional designer, and our designs are not always careful. Perhaps too we should think about who we should give the most protection. I'm an old-fashioned enough to think we should give first priority to the children, the sick and the old, as Michael Joseph Savage once articulated. He would not be satisfied with that we achieved his ambition today. What I might differ from Savage was the realisation that the government had not unlimited ability to protect everybody, to ensure the entire economy from uncertainty. Or it could so at a horrendous cost to our material standard of living. For as long as there is economic certainty, there will be financial crises. That may be a cruel reality, but what a boring world it would be if everything was certain.